Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing TC Energy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. TC Energy develops and operates energy infrastructure in Canada, the United States, and Mexico. The company operates three core businesses: natural gas pipelines, liquids pipelines, and power/storage. The natural gas pipeline network includes 93,000 kilometers or 58,000 miles of gas pipeline, which transports more than 25% of North America's natural gas. It also operates one of the largest natural gas storage businesses, with 653 billion cubic feet of storage capacity. The liquids pipelines division includes 4,900 kilometers or 3,000 miles of oil pipeline. This segment ships 3 billion barrels of crude oil, consisting of 20% of Western Canadian exports. The Power and Storage Division owns or has interest in 7 power generation facilities with combined capacity of 4,200 megawatts, powering 4 million homes. In January of this year, President Biden signed an executive order to revoke the permit that was granted to TC Energy for the Keystone XL pipeline. The pipeline became well known when it attracted opposition from environmentalists, becoming a symbol of the battle over climate change and fossil fuels. Although this decision by President Biden was not good for TC Energy, the company adapted and is aggressively growing its infrastructure by investing $21 billion through 2025. $17 billion of the $25 billion will be invested in natural gas pipelines. This investment will lead to significant cash flow growth in the future. The company offers a generous dividend yield close to 6%, with 20 consecutive years of dividend increases. We're going to look at the dividend closer later in this video. Pipeline companies make money by transporting oil and natural gas from the well to refineries. As a general rule, these companies charge by volume and by distance. So the more oil or natural gas shipped, the more money they make. Lower oil prices should benefit this company because the lower the price of oil, the more demand for it. On the other hand, higher oil prices will reduce demand for oil. Just something to consider when investing in a pipeline company. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1951. It started trading in 1973 and can be found on the New York Stock Exchange, TSX, Deutsche Börse, and Dusseldorf Stock Exchange. Let's get started with the model. This is a large cap company, 58 billion market cap. They're trading at $59 a share, and they have 979 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they did have negative free cash flow in 2018, 19, and 20 because they were investing so much money in CapEx. They did have a small positive in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And you can see that's positive every year because even though they invested a lot back into their business, capital expenditures are spread out over 10 or 20 years. So the net income is smoothed out using depreciation. Revenue is a sales for the company, and that's pretty consistent year to year, around $13 billion. This is the company's income statement. The top line is the revenue, the sales. So here's a breakdown of their revenue in 2019 and 2020. Revenue from U.S. natural gas pipelines is their biggest generator. It went up a little from $5 billion to slightly over $5 billion. Canadian gas pipelines went up about 10% from 2019 to 2020. The Mexico pipelines went up about 20%, and their liquid pipelines and power and storage have decreased from 2019 to 2020. Below revenue is the cost of revenue. Their main cost of revenue is the cost of oil. The price of oil must have came down a lot because you can see in 2018, it was $1.2 billion more than the trailing 12 months. And their revenue in the trailing 12 months wasn't that much lower than 2018. So they do have a pretty high gross profit as a percent of their revenue. It peaked in the trailing 12 months at $10.5 billion. Below that is operating expenses, and their big operating expense is depreciation. Because they spend so much in capital expenditures growing their pipelines, each year they have to pass through depreciation expenses on those capital expenditure investments. Gross profit minus operating expenses gives you your operating income, and that also peaked in the trailing 12 months. And they have a lot of debt on their balance sheet. They paid $2.2 billion of interest on their debt. They had negative $1.7 billion in other expenses. Companies like this have so much assets on their balance sheet, they're always passing through asset impairments or the gain on the sale of an asset. Also, they have investments in other companies which go into other income and expenses. So the reason they had their lowest net income in the trailing 12 months was due to this negative $1.7 billion in other income and expenses. So I would focus on operating income when I look at the income statement, because the stuff below operating income can really skew the numbers. You can see their taxes are pretty low as a percentage of their pre-tax income. That's because they're able to defer taxes. They also receive tax subsidies and tax credits, since oil is considered a vital commodity. This is the statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. You can see their operating cash flow is pretty consistent year to year, while their net income is all over the place due to other income and expenses. Also, their operating cash flow is a bit higher than operating income because of that large depreciation expense that brings down their operating income. So they do generate a healthy amount of operating cash flow. They invest a ton back into their business. They invested $10 billion in CapEx in 2018, then $8 billion, then $8 billion. Ideally, you would want to invest in a company with positive free cash flow. But if a company has negative free cash flow because they're investing so much in CapEx, that's not a bad thing, as long as they have positive operating cash flow, which this company does. If they really wanted to, they can invest nothing in CapEx and have tons of free cash flow. But companies generally look on a long-term basis. They're not investing in a short term. They want to grow the company and stay competitive. So about half of their operating cash flow goes towards dividend payments. So they don't have enough operating cash flow to cover their capital expenditures. So they add several $1 billion of debt every year. It is a little concerning seeing a company add so much debt. But as long as they use the debt to invest in a project that pays a higher interest rate than the interest they pay on the debt, then it's fine. They also issue capital stock to fund their business. They issued $1.2 billion in 2018, $250 million in 2019. So every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. This is the equity section from the company's balance sheet in their second quarter 10Q. They have $32 billion of equity. They raised $27 billion from issuing common stock, $3.5 billion from issuing preferred stock, and they generated $3.6 billion of profit. That's after paying out all their dividend payments. So that's a good sign when you invest in a company with positive retained earnings. Retained earnings is a sum of all the company's profits since they started as a business. Accumulated other comprehensive income, this is $2.4 billion of unrealized losses on hedging agreements. Unrealized losses are losses that haven't been satisfied. For instance, if you own stock and you're down 50%, you didn't lose any money until you sold the stock. Same thing if you own stock and you're up 50%. You didn't make any money until you sold the stock. So the company didn't lose $2.4 billion until the company terminates these hedging agreements. This is a little confusing because I'm used to seeing additional paid-in capital really high and common shares really low. Usually common shares is a really small number, like 1 penny per share. So can anybody tell me in the comments why common shares are so high and additional paid-in capital is so low? The numbers look correct if they were swapped. I'm just not used to seeing additional paid-in capital so much lower than common shares. Let's look at the capital structure. $32 billion of equity, $53 billion of debt. That 38% equity, 62% debt. So that is a lot of debt, $52 billion. And when debt is due, companies usually don't pay down the debt. Like for instance, if $5 billion of debt was due this week, the company wouldn't use $5 billion of cash to pay that debt. They would issue $5 billion of new debt to pay down the old debt. Companies just roll the debt year after year. If a company does have extra free cash flow, they'll use some of that free cash flow to pay down their debt. But if they don't have extra free cash flow, they can't pay down debt. So there is a possibility interest rates will go up a lot. If interest rates do go up and they roll their debt, they're going to have a higher interest rate to pay than on the old debt, and that could really raise their interest expense. So right now it's fine, but I know that's a concern for a lot of investors. Their weighted average cost of capital is 5.4%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for. That's $63 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $54 billion. We divide that by 979 million shares. And we get a calculated stock price of $56. They're trading at $59, so they're trading at a 7% premium. It's a sell according to the model. So I grew their free cash flows 70% a year, and that's based off of how much they're investing into their companies. And their future free cash flow estimates were a lot higher when the Keystone pipeline was still around. When I last did this video, I projected their stock price to grow a lot more than $56. Now that they lost the Keystone pipeline, lots of analysts are slashing their future estimates. Simply Wall Street values the stock exactly where they're trading at. When I did a video on this company back in January, their value was $234, so you can see how much it's dropped. 11 analysts are pricing the US stock, and that's trading at $47. And the average price target for that ticker is $55, so they're a little bullish on this stock. This is where the stock has been trading since 1995. So you could see it went up, then there was a dip, it went up, 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 and now another dip. If history repeats itself, it should be another increase. That's pretty much how the stock has been moving the past 26 years. But you can't really tell how long it will take for the stock price to increase. In this case, it went up straight for about 10 years. Then it dipped. Then it went up straight for about 7 or 8 years. Then it dipped. Then it went up really fast over a few months. And when it dipped this time, it also went up really fast. So will the incline this time take a decade, like these times? Or will it be a really fast incline like these two times? Nobody really knows. So 12 months ago, the stock was trading at about $65 a share. And then it dropped a lot. And it's come up back to about $65, but then it's regressed a little bit since then. So this company has been raising their dividend for the past 20 years, as you can see here. They pay pretty close to a 6% dividend yield, and the payout ratio is really high because of that large asset impairment. But if you strip out that asset impairment, their net income will be about $3.8 billion, which would give them a payout ratio of about 80%. And we can't look at their dividend over free cash flow since they're investing so much back into their business. They have such low free cash flow. They do pay a higher dividend than their industry, which pays a 4.8% dividend. And analysts are forecasting their dividend to grow to 6.2% over the next 3 years. They have a pretty low beta, 0.76, so the stock moves a little less than the market. It's not too volatile. It's gone down 8% in the past 52 weeks, while the S&P 500 went up 29%. The 52-week low was 51, the high was 65, and the stock is trading below its 50-day and 200-day moving average. About 4 million shares are traded each day the past 3 months. Pretty much all the shares outstanding are on float. 77% are held by institutions, and 3.6% of the shares are shorted. The stock has gone down the past year while its industry went up and the market went up. But in the past 3 years and 5 years, this stock has done much better than its industry and a little worse in the market. Analysts are bullish on their earnings, expecting them to grow 38%, but a little bearish on their revenue, expecting it to grow only about 5%. In the past 5 years, their annual earnings increased 32%, which is really good. But in the past year, it decreased 54% due to that large asset impairment. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $17,000 today. That's a 5.7% annual return. The biggest shareholder is Capital Research at 9%. Since they're a Canadian company, Bank of Montreal owns 4.35%, RBC owns 3.12% and 2.9%, and Vanguard owns 3.1%. Let's look at their financial ratios. Their PE is decent, 28. That's between the market median and average. PE is stock price over earnings per share. Price of sales is also decent at 4.4. That means investors are paying $4.40 for $1 revenue. Their price to book is really good at 1.8. And the way you calculate price to book is stock price over book value per share. To calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. And they have $32 billion of equity, but about $20 billion of tangible equity since they have $12 billion of goodwill on their balance sheet. A company gets goodwill on its balance sheet when they acquire another company for more than it's worth. So their tangible price to book ratio is probably closer to 4. They have a decent return on invested capital, 6.1%. It's greater than their WACC. They can cover their interest payments almost 3 times. A decent ROE of 7%. They have a pretty low current ratio and quick ratio. So they have $3 billion of cash on their balance sheet, $2.7 billion of receivables, and $800 million of inventory. So the company is really undercapitalized. They only had $200 million of free cash flow in the trailing 12 months. That may be a lot higher over the next 12 months with all their infrastructure projects in place. They have negative $5.4 billion of working capital. Working capital is current assets minus current liabilities, and they pay $3.4 billion of dividend payments. So they're short about $8.6 billion. So they're going to need more debt to run their business over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 45 other companies in the same industry as TC, and TC is a lot worse in PE and price to sales. They're a little worse in price to book, a lot worse in current ratio. They're about average in ROE and debt, but they're a huge company, much bigger than the average company in this industry, and they do pay a higher dividend. So to summarize, I have them trading at a 7% premium, and this stock may suffer a while because a lot of people are probably bearish because they lost the Keystone pipeline. But they do seem to have a lot of projects in place to replace what they lost from the Keystone. And if that is successful, the stock price can go up a lot. And don't be concerned about oil being replaced by more greener products. Oil will always be around and it's always going to be growing. And things like electric vehicles will also grow. There's always going to be demand for those products. And as long as this company can continue doing what it's doing and build out their infrastructure, this should be a good investment, especially if you're a dividend investor. I rank their free cash flows 5 out of 10, their revenue 7 out of 10, and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.